RealBusinessTalk.com. Connecting expert talk with real business success that makes your network your net worth. The tools to succeed in real estate, in business, in your life. Join the talk. Receive the latest business talk. Subscribe now. RealBusinessTalk.com.
Welcome to Real Business Talk. I'm your host, Robert Crawford. Today I want to talk about a number of issues going on with business basically around the world. I want to touch on the tech scene for a bit, and then let's get into some government endeavors that could really be hindering the market. The first thing I want to touch on, though, is about real estate, on how numbers came out today in Business Insider. Actually, I'm reading this article saying that the housing new home market has begun to collapse. Basically, the housing starts fell 17% to an annualized pace of 987,000 units. Basically meaning that we've almost seen a 20% drop in new home development. So what does that actually mean? Because they were expecting a drop, but they weren't expecting a drop that drastically. They expected it. We saw a small drop in January of 2.4%, but surprisingly, we see an increase in building permits of 3%. So building permits are still at a steady pace, yet the actual new homes coming onto the market and beginning construction are lower. This is really about a long-term economic view on the real estate market. It's telling me that housing investors, hedge funds, and companies that specialize in developing properties are looking at the real estate market, 6 months to 5 years out, and they don't have an extremely optimistic view. So how could this be if our interest rates are at record low levels and they still don't have an economic view that's positive? How are we going to get out of this mess? Well, the issue is we may not get out of it. We're going to continue to see housing pretty much stay steady for the next coming months unless you're in extremely populated areas, such as where we're at in Southern California. Here on the west side of Los Angeles, we're going to continue to see a hot market just because inventory is so low. There's only so many houses for how many people actually want to live in this area. But for the rest of the country, it's going to be tough. It's going to be tough for a number of reasons. And I think one of them really comes from this other article. The Associated Press says the unemployment rate has dropped in 24 states, stating that in North Dakota that has the lowest unemployment rate of 2.8%. Well, the problem is these numbers are basically a blatant lie. They're just not accurate at all. And it's only reflecting brand new unemployment. This is not reflecting anyone that's been in the unemployment market, lost their job, and has been looking for a job for a number of years, and they basically have given up. Those numbers are out of this. It's not counting anyone that's taken a job just so they could get it, even though it was a part-time job and it doesn't even cover their bills. That's really about 20% of the market right there, and it's not reflected in this. It's not reflected in anyone that was taking a full-time job and was then cut down to less than 30 hours a week so the employer could comply with the new Obamacare regulations. None of that is reflected in any of this information. This information of the unemployment rate really reflects nothing. What reflects is how much people are spending in the market, because if you're spending money, that means that you have money to blow. If you can't afford to pay your rent, you can't afford to pay your mortgage, you're deciding between paying your electric bill or putting dinner on the table, you're not going to Target to purchase your electronic devices, which is why we've now seen Target has decided to close, I believe, all their stores in Canada. If the economy was really doing so well, why would one of the biggest retailers, one of the biggest companies, decide to close all of their retail locations? Sure, you might say, Well, Robert, they just want to save on their margins because it's a lot cheaper to just do online sales than to manage all these stores and all these employees. And if the stores begin to lose money, then what's the point? You might as well close them down. Well, that's a good point. But you have to remember that these stores, even a small decline in sales, let's say 3 to 5%, is catastrophic. Their margins are so slim with these big box retailers, the Walmarts of the world, the Targets, even the retailers like McDonald's. Their margins are so slim that even a small drop is catastrophic to their overall business plan, which is now why you're seeing McDonald's and companies like Coca-Cola and Pepsi take giant hits. Their stocks are coming down and they just are not selling the way that they are. Although those companies is really more about their product, it's about education in the market. I think people are waking up. They want higher end products. They don't want GMO foods anymore. They want real food, and they basically are voting with their dollars. And I highly encourage you to do the same. The biggest vote that you have is with your money. You get autonomy and decide where to spend your money, except when it comes to taxes, and that's a whole other discussion. But if you are not happy with a product or service, you should not be buying from them unless you have no other choice. I know that there's very limited choices on where you get your internet, where you get your electricity. Obviously, they've put those monopolies in place, but anything else, especially when it comes to food, you need to be voting with your dollars, because you may think that it's harmless to go through the McDonald's drive-thru because your kids are complaining in the back seat. You just want something quick and easy. But remember, every time that you purchase from a company like that, you're supporting what they're doing. So make sure that your personal beliefs and views line up with what that company is trying to accomplish. But this really goes back to the overall economic factors that are in play. And I think a lot of people still don't understand how the economy really works. They think that the government issues dollars, those dollars are out in the market, and they're just being gobbled up by debts or basically going into a mystery hole. They don't understand why the economy is not picking up like it should. And it comes down to the basic factor of how the monetary system in the United States works. Again, the Federal Reserve is a private corporation. It is not owned by the government. It is owned by a private conglomerate of shareholders. We don't even know who these shareholders are because it's secret. Not even the Congress of the United States or the president can audit the Federal Reserve. They have no idea what is going on behind the closed doors. And in 1913, when the Federal Reserve Act was passed on Christmas Eve in Congress, what happened is you basically gave this private corporation complete control to print money. They don't allow individuals like you and me to print money. If I printed $1 and tried to use that dollar, I would go to jail. This is the only company in the world that is allowed to print dollars, and they're called Federal Reserve notes. They are now backed by nothing, and more importantly, for every dollar that's created, they ask interest to be paid back on that dollar, which means that when the government needs money, whether it's to bail out the bank, to write a loan to one of the states, to pay for their own financing, they create a bond and then sell that bond to the Federal Reserve. The Federal Reserve will then print the money and then give it to the Treasury to use for the expenses. Well, if they print $100, they expect that $100 to be paid back plus interest. The entire problem with the debt bubble arises with this system because it's impossible to pay back that interest when that money didn't exist in the first place. If they've created $100, there's only $100 in creation. How can you pay back more than the $100 if there's no more money? So you can see this entire system is a Ponzi scheme. And because of this Ponzi scheme, they have to pay back this interest, which cuts into the budget, which then they need to borrow more money to pay for the budget, which creates more interest. So what we're seeing is this interest bubble widening. And every time that they print money, it's lowering the use of our own personal money. It's inflating those costs, sometimes deflating it. And now that it's the global reserve currency, it's really on a worldwide level. So that's why you're seeing all these other first world countries get together and try to create alternatives for the dollar. The BRICS Bank, which was first developed a few years ago by Brazil, Russia, India, and China, has put up $100 billion of solid, real gold to start the BRICS currency, which will compete directly against the World Bank and the IMF and the Federal Reserve, and basically give other countries an option besides the dollar, which is backed by nothing. We're very fortunate in the United States that other countries are still accepting dollars. The problem will arise when people no longer want the dollars for their trade, and then they all come back to the United States. It'll then be like we have monopoly money. But we're not at that point yet, but we're getting there. And you can see that how these interest payments are crippling the entire economy because it trickles down from the federal government spending. In the LA Times right now, we see an article that says California public workers may be at risk of losing their promised pensions. Let's talk about that in a second when we come back. Welcome back. We're talking about the effect of this monetary system and the interest rates and how that affects the entire economy. We're seeing that new home prices are beginning to trickle down in the economy. But I'm still optimistic about real estate if it's a cash flow investment. I always recommend, if you are thinking about purchasing real estate, you should purchase something that's going to produce you long-term income, because then it's not as reliant on the market price fluctuations. Let me give you an example. You can choose between purchasing your own personal residence, which is an expense. You will have to pay for that mortgage payment. If you have all cash, either way, either decision's good for you. But if you are financing the purchase, you can decide between purchasing your own residence, where you pay your own mortgage, you work to pay your own mortgage, and it's an expense every month. Or you can take that same amount of money and invest into rental units. This could be a multi-family property. This could be condominiums. It could be even commercial real estate. And then you can rent out that property. And as long as you do your calculations, you have to get a good realtor, or you really have to understand what you're doing to make sure that you're getting a deal that works. But as long as your expenses and the mortgage payment on that property is less than the rental income, you're in the green each month. So even if the prices on real estate fluctuates, it could come down 10%, it could rise 10%. Either way, it's not really going to affect you months after month because your rental income is still covering your expenses. I highly recommend you do this until you have enough rental income to then cover your own personal residence. Then you're going to be getting both really for no monthly payments. You want to make sure that you're in the green each month. The problem with financing your own personal residence is it's an expense. It's a liability. It's not an asset, and people don't understand that. It's a liability until the mortgage note is paid off on that property. The mortgage note is a liability. You can have that home. I've seen this happen so many times because I work with plenty of people that are within the foreclosure process. They've received notices of default. They've even received notices of sale, and the house is going to auction. They've paid for that house for 15, 20, 25 years. They owe a very small amount of money on that mortgage. Sometimes if the home's worth $1 million, let's say they only owe $100,000. Well, if they miss one of those payments, they're now in very hot water. So it's a huge liability because you have to consistently make those payments. And if you don't, after a few months, they could repossess that house. And now you're out all the money you've spent over that time period, and you don't own the property anymore. So again, understand that your own personal residence can be a liability, but it can also be a lifestyle decision. If you can comfortably afford the payments, if you have a thriving business, you're making plenty of money, and you can afford those payments, it's still a good decision to purchase your own residence compared to renting just because of the tax benefits. Also, the lifestyle. You might want a more comfortable lifestyle, something that's not offered in a rental unit. But let's get back to the economy and why I see this going down, and why we're on almost this edge of this cliff in the business world. Let's go back to this LA Times article where it says California public workers may be at risk of losing promised pensions. This is basically stating that the millions of people employed by the California state government are feeling the heat because of their budget deficits. So what we're seeing happen in California is a number of California municipalities, basically cities, counties, even the entire state, are beginning to file for bankruptcy because they just cannot afford the ballooning interest payments on the debt that they had to borrow because their expenses were too high for the revenue coming in. Their only option has been to increase spending and tax more. Yet they give out entitlements to individuals. I don't even think the entitlements are the problem. That's not the debate. Because corporate entitlements are more than 100-fold the entitlements that are going to the individuals for their health care and food stamps. That's not the debate. That's not the majority of the money that's being spent. Much more money is being spent on the interest payments on the debt borrowed. And these banks are trying to collect, and they're forcing the municipalities to go into bankruptcy. So basically what happened is a public finance lawyer named Carol Denniston, who's been arguing these bankruptcies through these municipalities on behalf of her clients, are saying that next time that we see Chapter 9 bankruptcy filings, pensions will be up for negotiation just like every other creditor. So what does that mean? That means that don't think if you are a government employee or even if you're a normal employee with a 401k that these pensions, these retirement plans are 100% safe. They are not. You need to be very concerned about this because we're just now seeing the beginning of what's going to happen. As the economy continues to decline, except for a handful of sectors. Of course, there are still places that are doing very well, but the overall economy is in trouble. As it continues to decline, and as these budgets continue to be imbalanced, we're going to see more and more of these arguments come up. It may not happen this year. It may not happen for 5 years. But if you're going to retire 10 years from now, you need to have a secondary plan. That might be real estate purchasing. It might be wealth advisors and investing with them. It may be a combination, which I recommend. I also recommend holding on to precious metal assets. Because as the dollar and the stock markets decline, generally gold and precious metals will rise. We've also seen a number of different sources. This is on record that all the markets are being manipulated. The stock market is being manipulated. The gold market is being manipulated. The oil market is being manipulated. So it's very hard as an individual to tell what is going to be up and what is going to be down. That's why real estate is always going to at least be useful. And if you're protecting your money in real estate, again, as a cash flow investment, it's a good idea. Now, I want to go back. Let's take a break and we'll come right back. Welcome back. I want to start talking a little bit about the tech scene now. Any of you that have been following me, you know that I am very big into tech. I've run my own tech companies. I currently have a few websites right now. And I follow what's happening, especially in the financing and venture funds of these tech companies. Right now in the Wall Street Journal, Pinterest has now raised another round of funding. Raises $367 million for a total valuation of $11 billion for a company that's producing very little revenue at the moment. So what we're now seeing, and if I have a great article up here actually by Mark Cuban on his Maverick blog, what we're now seeing is an entire increase in the tech bubble, just as we saw in the 2000 era. Why? Because there's so much free money. And we're not talking about just publicly traded companies like Facebook and Twitter. Although of any of the tech companies, Facebook is probably the strongest because they are actually producing real solid revenue numbers. I mean, God knows that I'm spending a fortune on Facebook every month. And if you want to learn how to build Facebook with your business, you can find my Facebook Master Course on realbusinesstalk.com. Or you can find my book on Amazon, Facebook Advanced Marketing. But that's a whole other discussion. Right now I'm talking about why I believe we are in a new tech bubble, but it's more of a private financing bubble. And this is really what Mark Cuban goes on to explain, is that we're really in a new tech bubble. That stocks, back in the day, a company would go public, a .com would go public, and their stock would go crazy, and then eventually it just all came crumbling down. Only a small percentage of them actually survived, like Yahoos, the AOLs of the world, the Googles. But what we're really seeing now is a huge increase in private equity money. And what he goes on to say is that according to data, there's over 225,000 angel investors. Angel investors are a private investor or a small group of investors that invest in startup companies. This could be very early stage companies with seed funding. It could be companies that have now produced a product and need money for growth. These angel investors are really adding to the boom because there's so many of them out there. Of course, you still have to have a good idea for them to get on board. They're not just going to throw money at anything. But the fact that there's so many of them out there are making it easier and easier for entrepreneurs to find the startup money they need. Not only that, but because of the new jobs bill that was passed back, I believe, in 2010, you're now seeing a brand new form of investment coming out called equity crowdfunding. Basically, it's crowdfunding like a site like Kickstarter, and if you don't know what that is, it's a website where I can put my idea up there and people can purchase or donate to or gift to that idea. Kickstarter has done great. It's been able to get a lot of businesses off the ground and produce some really fantastic product into the market. I think it's a huge benefit to the economy. And what we're seeing is that Kickstarter crowdfunding model now going into the equity scene because the SEC is now allowing it. Of course, there are some specific regulations for this, but basically you can raise your money in essence, sell private stock to your startup company or your company through crowdfunding. Basically, an aggregation of different small investors that are purchasing smaller pieces of your company that will equal into the raise that you need. For example, let's say you need to raise $1 million and you want to put up 10% of your company. That means you're valuing your company at $10 million, which is fine as long as you can justify how the company is worth $10 million. Well, that 10% equity could get bought up by a private angel investor or a venture capital firm, writing you a check for $1 million and then receiving the 10% of stock in exchange. Or it could be bought up by 1,000 different investors, each receiving a portion of that 10% stock. So each would receive about 0.1% of the stock. Now, of course, that's just rough estimates, but just giving you an idea of how equity crowdfunding works. So I believe what we're going to see with these equity crowdfundings is a number of startup companies will basically be able to raise this money easier with less hassle, which will allow them to start the companies. There are going to be plenty of great legitimate companies that come up this way. But there's also going to be a number of companies that are fairly fraudulent. So you have to make sure that you're doing your due diligence. More importantly, you have to keep in mind that these investments, many of them will go underwater and you can lose that entire investment. This is really similar to how penny stocks work, or pink sheets, in the stock market system. Pink sheets are speculative companies, but instead of raising private capital, they've been able to go public and can now be publicly traded through different brokerage firms. So basically you're seeing the pink sheet phenomenon now go into private equity, which has been around for a long time, but you've had to really be a serious investor to even understand how to play the game. Now this is widely available. So I want to tell everyone to be very careful with these sorts of deals. You have to do your due diligence. You have to make sure that the team of that deal is great. And you just have to really be careful with what's going on. Now, if you are interested in this idea, or if you're an entrepreneur that has a business, you're trying to make money, Angel.co, which is called AngelList. It's a fairly new company, but it's really the biggest one out there that does this. And it allows investors to syndicate deals, meaning get a group of investors together to invest in deals. And it allows startups to put up their company, tell how much money is being raised, and then people can commit to certain percentages of that funding round. So if you are trying to raise money for your company, and I highly encourage you to go after your dreams as long as you have a really good idea and you start building a great team behind it. But go to angel.co. You can discover a lot more about this. I'm not plugging them. I'm just saying that I've used this product myself. Go to angel.co. Check that out if you're interested in it. I'm going to end this broadcast with a little discussion on the Apple Watch. Because now we're seeing a lot of these technologies move into these quote-unquote wearables. I think the wearable market is too new to really say if it's going to be a success or not. I see issues with it. I personally am in no rush to purchase with this. But what I found interesting is the high-end watches that are being made with the Apple technology. I mean, just natively, they're releasing I believe, 18 karat gold version of their Apple Watch, which is, I believe, $10,000 or more. I also saw today that version has now been revamped by a jeweler, and you can actually buy a diamond Apple Watch. Now, this technology is great, and we're seeing it basically be a medium between the power within your smartphone and the ease of use of having it on your wrist. But I still think that it's so new that we haven't really seen what the uses of this are. I know one of the biggest ones are going to be electronic payments. Electronic payments are going to be the huge thing. And this is a very slippery slope. We can see this especially with the government prosecuting a number of people for just taking out cash from business accounts. They're prosecuting people who are taking out more than $10,000 to pay for business expenses, but in cash. We're seeing a huge tightening on the IRS on cash. We're seeing police seizures in every state from people carrying cash, whether they were innocent or guilty, and we're seeing that it's extremely difficult to get that cash back. So what we're really seeing is a war on cash. Why? Well, it's because the banking system wants everything electronic for a number of reasons. One, as we've already discussed, they can control the creation of monetary policy. They can print money, and it's much easier to type in some numbers on a computer than to actually fire up the printing presses. Two, they can have direct control over you and your actions by confiscating your bank accounts with just a click of a button. And this is a huge concern. I'm concerned about this personally, and I think every single person in America should be concerned about this, because the moment comes, and we're actually seeing it in action right now. People don't understand that this is happening to tens of thousands of people, where the IRS or some other agency is coming and confiscating entire bank accounts with no warrants, with no evidence of a crime. They're just doing it. And we're seeing the evidence that the IRS is doing it, especially the people that don't have the correct political message, quote unquote, for the White House. They are basically targeting political opponents and confiscating their funds. And we're seeing this over and over again. So as I leave this broadcast, I want you to think about, if you are running a successful business, if you have successful savings, or if you've just worked your butt off and you now are thinking of investing, or you have a pile of cash that you want to protect, think about this. Do we really want to go to a cashless society where the banks are in full control of our money? Sure, it may be convenient, but is that convenience really worth the risk of someone clicking a button and emptying your account? We've seen this with financial fraud, people stealing identity theft, and now we're seeing it on the government level. So there's a lot of security concerns with this type of transaction, with going paperless. We've already gotten off the gold standard, and we've gone to just a fiat currency. Fiat means a decree. The government says that this is the currency, is the only one we can pay, quote unquote, taxes with. Is this really something we want to see bleed into every aspect of our lives? Because we're really at a fork in the road. We can decide to go either way. We can decide to go towards the road of digital currencies and trust that the systems they put in place are going to protect us. Or we can say we're not fully trusting in that. We don't know who really has the full control. And we want to go back to a hard asset of some sort. I always recommend you have at least some hard assets. And that doesn't mean you have to have a stockpile of silver or gold in your house. Assets could be a number of different things. It could be jewelry, it could be real estate, it could be paper bonds and stocks of companies. There's a number of different aspects that you can invest in. I just want you to begin to think about it. So that's been our talk today. Thanks for joining Real Business Talk. Please subscribe if you haven't already. Please help spread the word. If you have any questions about what we've discussed, you have topics that we want to talk about, or if you want to join the discussion yourself, please feel free to reach out to us, comment, or join the forums at realbusinesstalk.com.
realbusinesstalk.com. Connecting expert talk with real business success that makes your network your net worth. The tools to succeed in real estate, in business, in your life. Join the talk. Receive the latest business talk. Subscribe now. realbusinesstalk.com.